Welcome to the Pure Property Podcast. Whether you are considering buying your first investment property or reaching property mogul status, we dissect the fundamentals through to large-scale property development and everything in between.
G'day, how you going? Phil Tarrant, co-host of the Pure Property Podcast with Paul Glossop. We're back in the studio. He was overseas the last time we got together, but he's back in Australia, getting stuck into it. Paul, good to see you.
Well, thanks for having me, mate. In the fancy, well-lit new studio.
Soft lighting.
Soft lighting.
Make us look, I was just looking in the screen just there, and I thought, I've got a bit of a suntan. But
yeah,
I think there's a bit of soft lighting.
You reckon? You reckon? No, it's tough with age and lighting. Is that the older you get, the more you want less lighting.
It does.
Ideally, you're just going to be a voice. You just go and go straight to non-AV. Just audio.
Well, that's how it used to be. It used to be called a podcast. Now they're video podcast, right? Like
let's go old school next
old
time.
School.
Yeah,
I'd rather sort of not be on the television and the camera, but. Anyway, this is what they tell me I have to do in order to get a paycheck these days, which is struggle streets, tough out there in property.
It is.
We'll get stuck into it, and we'll introduce our guests first off, but then we'll get into our regular segment. We're going to have a good chat today. Ali Akbarian. Ali, welcome to the show. We're going to get stuck into the story, and I've heard a lot about you in the background, so I look forward to having a bit of a yarn through your property journey. And I know a lot of people who tune into this podcast, which is very popular, like the stories of people doing good, and it can be done, and doing it in a way in which is sustainable and scalable, and that's what most of us want as property investors. What's making property news?
What's making property news?
What is making property news? Paul, I see, despite all the noise and the rhetoric around championing housing affordability in Australia and all the stuff's been happening in the background, making more homes available to try and take the ease off the supply side of things, we're actually behind
surprise
on development approval, not to what the bold ambition was based on what has happened previously. So we're doing worse today in terms of building approvals than what we were
when
previously.
The whole rhetoric started.
Yeah,
brilliant.
That's not good, is it?
Well,
or is it? It's good if your own property, I guess.
This is the hardest thing. Is like you do wonder what the genuine intention is here. But I mean, you look at intent versus action, and I have to say that there is action happening across the board. But I mean, ultimately, approvals are down circa 10% on 5-year averages. So building approvals, residential building approvals are down circa 10% on 5-year averages. Now, it doesn't take a genius to figure out what that means. And we've talked about this a lot, is that approvals don't mean property available. Approvals probably give you an insight into the next 2 to 3 years, because that's the big thing to look at here. Is that I know, and if we reflect back, say circa 2015, 16, 17, particularly in certain markets, or even a little bit earlier in 2010 to 2013 in Brisbane, 15, 16 in Sydney, and probably like 2005 to 2015 in Melbourne, when we talked about that absolute explosion of high-rise apartments, that does affect markets for the negative, and it did in all those markets. In particular, at those certain wedges of time, there was a cascade lag that led to softening of high-rise apartment values. That's not happening. So if you want to have a crystal ball, approvals, and also when you're looking at things like mortgage loan approvals, and then also things like actual migration numbers, when you start to put those things together, you say, okay, we've got more people, less properties approved, less properties are going to hit a market. Surprise, surprise, what happens? It puts more pressure on the existing properties that are there, and they go up in value.
So the forward-looking situation ain't great. So building approvals is, hey, I want to build something, an apartment block, a townhouse development, or
residential,
just a residential house or duplex, whatever. I send it into the council, and they go, yes, Mr. Glossop approves you're allowed to build this place. And then what you got to do then is go through all the stuff to actually get that out of the ground. A couple of years, because building approval can last for a number of different
long
years.
time.
And you can actually sell that, alongside with an actual property. But so what we're looking at is there is less approvals happening today, which means that there's going to be less houses or residential units or whatever it is coming out of the ground in 2 to 3 years' time.
Yeah. And I guess the biggest thing that I look at here is that, and what hasn't been a problem necessarily, is actually approvals, ironically, because the approval is not where the bottleneck is and hasn't been there since really the start of COVID. It's been the actual construction cost and the development component, because to your point, Phil, And Ali's probably got a couple of things we just spoke off air about something he's considering a property that he owns and looking at converting something into it today, is that it comes down to the feasibility of actually building what you can approve and then doing your numbers to say, A, does it stack up at the end of the day? B, will the bank give you the numbers? And they'll only give you the numbers if it stacks up. So I'll give you the money if the actual return's going to be that plus a margin of safety on top of that. And then when it comes down to it, that's the part which doesn't look like it's going to change anytime soon. So we've got this issue of cost.
So there's a whole bunch of noise around. There was all that rezoning all over the joint semi-recently, and you hear it in the papers every day of, this person, they're all bundled up and they're going to sell this big parcel of land and sell it to a developer. So those sort of things are taking place.
They are.
However, it's dry powder. So people might be consolidating these lands or buying for the purpose of development, but they're just not yet putting their development approvals in because they're saying right at this moment, it doesn't make sense to actually build.
Yeah.
So something significantly needs to change in order to accelerate that. So it means that either labour's got to get cheaper or building materials got to come cheaper, or the value of property needs to go up rapidly in order to satisfy those increased costs.
Yeah.
And it's probably going to be the latter, I think.
Well, I think that's the challenge, right? Is that I think it's going to be the latter will be probably more of an incremental. You're not going to see like a 20% explosion in a 6 or 12 month period of time anytime soon, in my opinion. But the aspects around labour getting cheaper, materials getting cheaper. I mean, you go look at the geopolitical environment. You go look at everything else that we've got in the labour market. Unemployment's still sub 5%. That's not changing anytime soon. We're not seeing this explosion of new people coming with skills, and the employers can take them on cheaper. None of that's happening. Yeah. So I think we're in a stalemate for a relatively prolonged period of time.
Unless once AI takes every white-collar job away from people, everyone will be back on the building sites.
Yeah, exactly.
Schlepping bricks. Yeah.
Nice one. Good
and
luck
that's when a lot of people start going, oh, God, life was pretty good. To all the builders out there, keep up the good work.
Absolutely.
Big fan of builders. They do it well. And in many ways, their relevance to the importance they provide in terms of economic activity is only going to grow.
More than ever.
Yeah. I think 1 in 8 people now in Australia. These are people who actually work, not the people who are the 50% of people who rely on the majority of their income from the government. I think 1 in 8 are somehow involved in the building economy. So
doesn't surprise me.
I don't want to be a cynic there, people, but you
are.
Yeah, but maybe we are. But okay, so that's good. So how does that extrapolate out then to these bold? What was the government said it was going to build 1.2 million new
dwellings
residences
over 5 years. Up until I think it was 2030. Was it 2030 or 2027 or 2028? We're a good way into this now.
30% under. Where's the current stat?
I think last we were there, we were circa 24% below our targets, and that's not. I mean, it's not going to change.
No.
I mean, you can go, and again, we can go and change approvals left, right, and centre. We can go and just give automatic approvals to shonky developments, DAs, etc. It's not going to make more property come out of the ground.
So what you're saying that even if they completely fix the development process, which is what a lot of the debate's been around. It's around it takes too long, there's too much red tape, there's too much bureaucracy, all that sort of stuff. Let's just say they perfectly remove all of that.
Yep.
You still might not get approvals because people go, it doesn't make economic sense to actually
Correct.
build.
You can give approvals everywhere.
Yeah.
You can. I mean, most people in Sydney and a lot of people in Melbourne who have owned houses that have been in the ground since the 1990s or earlier, I would go on a limb and say there's probably a good 60, 70, 80% of those properties could be developed into more than what they are, i.e. provide more accommodation than just a single dwelling.
Yeah.
That doesn't mean it's going to happen. You could say, hey, go to a letterbox drop and give them all an approval for a duplex. Even if they want to, it's not going to stack up.
Watch this space, right? Because there'll be a new government scheme coming out,
no doubt,
which will be exactly like like your pink bats thing, or what's it, solar at the moment, right?
It is.
Just going to everyone. Yeah, knock your house down, build a duplex,
no GST.
and we'll give you no GST, no this.
I talked to you about this a while ago.
There will literally
Phil.
be a scheme around this. I'm sure someone in Treasury, because they listen to this all the time, and go, "Well, that's another great idea. Let's do that."
But I did talk to you about it. Like, what are some of the big GST? Imagine you gave maybe a moratorium on GST if they really were serious about building more property for a period of time. So look, let's corroborate that 5-year target we have to no GST for builders to be able to build more property. We'll take away GST, 10% off for everything. Would that influence people? Yes, it would, but they're not going to do it.
No, they've got to feed the states, man.
Okay, and we've also got to feed the banks who own a good wedge of these properties because, I mean, ultimately it's all tied together.
Okay, let's not be cynical about this. But, anyway.
All right, so approvals are down 10%.
Listings are down as well.
Listings are down as well. So listings are down at 11%. And that's, again, shows you that there's less property approved, there's less property for sale. And what does it equate to? Well, we've seen 3 interest rate cuts this year. There may be a few more coming in the near future, maybe not. Maybe this is where we land. However, it's showing that every market other than one, every major city is growing in value. Surprise, surprise.
Okay, so listings are down. Do we yet have any? It's only the second weekend has just passed, I think, with this new 5% scheme that the government's got in place. And you look in the echo chamber, you read the papers, and there's huge queues of people out things and at auctions and whatnot. It's too early to tell whether or not it's actually making any.
Yeah.
But if listings are actually down, and this is spring, which is when most listings come on, that's just going to even put more pressure on those properties, that positive pressure on those properties that do go for sale. So if you're a seller right now, might not be a bad time to list, to be honest with you.
Well, if you're thinking about taking some profit, I mean, I actually have seen an explosion in certain areas in listings, and a lot of it is well and truly aligned to this, where you thought, well, how has this all of a sudden happened in the last 2 weeks? There's certainly been, I think, some vendors who have thought this is the time to make money. Now, it's all relative.
Right?
Yeah, exactly. You've got to replace it, or it's a point in time. I mean, you're not trying to pick the market, and if you are, you're very novice at this whole process. But I think, is it too early? Probably. But is it going to have a positive impact on prices going up? I can't see how it won't. I mean, even just before this podcast, I was on the phone to a client who's buying a property in their SMSF, but also is in a situation where they're girlfriend, not necessarily yet married, has capacity to buy a property as their first home purchase. So they're going to buy that as their first home in the Sydney market. They've got a cap now up to $1.5 million. There's unlimited spots. There's no stamp duty. There's no LMI. They can buy a $1.5 million property for $75,000 deposit if you've got borrowing capacity. I mean, this has never been the case.
And a lot of people are struggling with this, right? So here's a hypothetical. If you're in a de facto relationship, so for all the purposes of everything, and you're in a de facto relationship, however, only one of those people put in for the 5% deposit, and only one of those people are actually on the mortgage against the security, can both of those people go in for and buy a property at 5%? These are the nuances of it all.
Well, I don't think both can, because they both can't be on the title. I don't believe they can.
But
both.
Separately they can if you're.
Well, this is probably a good question for a broker to come on to talk about. Hey, let's say that scenario.
Because strategically planning, you need to be thinking about this.
Well,
right?
you should. I mean, if you're not, you're mad. Because if you're like, hey, let's say hypothetically we both earn $130,000 a year, and we're at a point where we've had a good corporate job or a business or whatever it is, and we're 5 years in, we've got a little bit of money, we're planning for our future, we haven't got an investment, we want to buy this as our first home, potentially an investment down the track. But can you go to the bank and say, well, you're in a de facto relationship. One person might have already bought their first home, so they don't qualify, but the other one says, hey, like I can. Does the bank say, well, you can't both be on the documents, because ultimately then you don't qualify?
And there's a serviceability challenge.
There's a serviceability challenge. But look, where there's a will, there's a way, I would assume.
Yeah. Anyway, I'd like to learn more about that.
Because it's a massive opportunity. It's the biggest opportunity I reckon first home buyers have had for decades.
Oh, yeah.
Yeah.
Oh, it's probably it's the best ecosystem it has been, and the worst as well.
Correct, because we've just talked about the supply issue, Phil.
Yeah.
Like, this is the thing. Like, we talk about this all the time. Like, great, more people can buy property. There's not enough property. Listings are down 11%, approvals are down 10%, and we're not building anymore. So tell me what's going to happen.
Well, it's more of it's a reality check for a lot of people as well. It feels as though there's only a handful of people talking about this in Australia, me being one of them. I think the Barefoot Investor is probably a voice of reason and sensibility as well, pretty much going, just because you only need a 5% deposit doesn't mean you should still be buying property, or you still should be buying at 95%, or you should be buying a more expensive property because your deposit goes further. I think a lot of people, when they actually get through the honeymoon period of getting those keys to that new home, and then they've got to work out that they're paying 95% of the debt rather than 80%, it's a lot of money to find every single month to put in there.
And you hit the nail on the head, because that was where my conversation with these clients went, is that, yes, look, you can pay $75,000 to get into this property, no problems at all, but you will forego any negative gearing benefits, at least whilst it's your owner-occupier. And they talked about, well, we're probably pretty tight on where our negative cash flow can go. I'm like, okay, well, this is what you need to do your math on, is that don't worry about what you can buy, it's what you can afford to hold, because this isn't a 12-month position. This is ideally a 10-year plus position, and that's what you need to start thinking about here is, do that math work backwards from that.
And it could stop you potentially investing for 10 years. So if you buy at 95% and when you're buying a home to live in, you're not necessarily buying for the purpose of investment. So you might not be buying something that's going to have rapid capital growth that you might see or hear about people doing on shows like this or elsewhere. So you could buy in somewhere at 95%, maximizing your serviceability to get your dream home, whatever that looks like, or dream property. You might be stuck in that for 10 years because you may not get the growth you expect to get, so you could refinance that property and maybe extract the equity, and or you might go into negative equity because a lot of the places that a lot of first home buyers will be buying under these schemes, a lot of them will be large scale residential units, which might not necessarily move that far. So be careful not to put yourself in a trap.
We've seen it before.
Buy something like this and you think it's great to get in, you may not be able to invest in property for a long time. Anyway, it's not why we're here today, but what's just quickly run me through the numbers on price performance over the last period?
So over the last month to September, so we've got Canberra up 0.4%, Sydney up 0.8%, Melbourne up 0.3%, Perth up 1.1%, Brisbane up 1.2%, Adelaide up 0.8%, Hobart down 0.2%, and Darwin up 1%. So that's been a pretty consistent theme probably for the last 6 months, I would say, as far as Hobart's been the main questionable market as far as where it's been going. It's been ebbing and flowing a bit above and below growth for the year. And if you look at for this last calendar year, it's probably it is the worst performing market. Melbourne's only just going through the early stages of this transition after the worst 5 years out of any market prior to. Darwin's been an outlier as far as seeing growth for the first time in a long time. The Sydney market's starting to show a bit more promise coming out of a pretty average 5 years as well. The big three of Perth, Brisbane, Adelaide are continuing on a pretty steady growth trajectory. How long that goes for, we've talked about this. It's not high risk territory, but it's certainly expensive territory. I will touch on one thing with Darwin, which is probably the last thing we'll close out this segment on in particular, is that if we look at investor lending, which is a really interesting one. Most markets, investor lending, as far as a percentage of investor lending to buy property versus the long-term averages, if I look at all the markets, every market other than Victoria are above their long-term averages. So nationally, we're sitting at about 37, bit over 37% as far as all lending is investor lending.
So out of all the home loans,
out
for
of 100 home
property,
loans, 37 of them are for investments. Now, long-term averages are about 33%. And I'll go through all of them. Victoria's at 31%. It's a touch below its long-term average. Every other market is probably 5% above its long-term averages, except for Northern Territory. So put that in perspective. Currently, it's at 44.2%. Long-term average is about 23%.
Yeah, something's not right there.
So you put that in, and this is where I say word to the wise of that. Those who are trying to chase really quick returns is that it is double its long-term average of the investor activity.
Is it NT or Darwin? Darwin's just not big enough.
It's NT, but Darwin makes up
a good Palmerston. Was
it
North Palmerston?
Yeah, I think it will ultimately, that'll, you put it all perspective.
I think it's bigger than Darwin now. But
but either way, that's all of NT. And then you think, well, people,
that's pretty much everything.
Yeah, that's pretty much
But
everything.
you're still probably talking transactions about the size of...
Dollar-wise, it's small, but if it's talking about the speculation component of it, where all of a sudden that's exploded in the last 6-8 months, in particular, the investor lending. So that's probably something just to be cautious of, is that it's not a market that's shown long-term consistent return. It's a market that's shown volatility. Some of that can be good, some of that can be quite bad. For those who bought there 10 years ago, they're only just making money now versus 10 years ago.
There you go. Well, that's what's making property news, which is always good to get stuck into to give a sense for the key factors shaping property markets. And the good thing about property, there's always something to talk about. And even when there's not, we can make it up. So don't worry about it. It's what we do here. But all you need to do is just pop out and go to any function, and most people will be talking about property. So there's always something out there. But what we do is like to do on the People Property Podcast is share investor stories, and Paul's brought in Ali today, who I think you guys have been working together for about 10 years or so, Ali.
Close to you.
Welcome to the show, mate.
Thank you very much.
There you go. Has Paul changed much in 10 years?
Yeah, he looks a lot better. He's much better looking.
Is he better looking?
He's less grey.
Yeah. Is it less grey? Less grey. There we go.
He's drinking from the fountain.
That's the opposite
that's a bit
of
suspicious.
That's the opposite of what you can say about yourself, there, Philip.
Suspicious.
I'm still running a bit of silver fox on the side,
mate. I'm aging naturally and gracefully.
Yeah, and that second part's questionable.
Yeah, well, this is right. But so how do you guys know each other? What's the connection?
I can't remember actually exactly. I think a quick background was I started doing property investing on my own. Sort of just decided I'll be this big time property mogul, and I got stuck in a bit of a hole with all these properties, and then I think I came initially across another investor broker person online, and on Facebook or something, and I went and met the guy, but I didn't really like him, and then I was like, but I like the idea of this, but I don't like this guy. So
you'd be surprised how often that happens.
Yeah, so I was like, well, thanks for selling me on this idea. I need to go scope out, other people, and I don't know actually where I found.
I think it was online initially.
Yeah, maybe
it was
just like an online inquiry.
Yeah. Back when Facebook was a bit more of a driving force of how to connect people in this space.
Yeah, and I met Paul at a cafe actually, not far from here, and just was kind of like, didn't do business at the beginning, but again, to his testament, he sort of just gave me advice along the way, and because I was kind of stuck, I wanted to buy more and thought I'm going to be this big property mogul owning thousands of properties like all these people you see on YouTube, but it's not that easy. You can't just go and buy properties, apparently.
Well, so sorry to bust the myth for a lot of people.
Yeah, I just thought, they all say it's so easy. Just buy one and then refinance, buy another one, buy another one.
Get a trust.
Yeah. And I was like, okay, I'll do all of that. And then, well, wow, no, suddenly bank says no.
Yeah. Yeah, bank says no to most people eventually.
Yeah, and I was like, but YouTube didn't say no. What happened?
It was one of the reasons why we started doing this sort of stuff. I was actually I don't want to sort of dampen people's ambition, but there's a good reason why when you look at the ATO stats, there's only, 30-odd thousand people in Australia with more than 6 properties. That's a fraction of the Australian population. Yeah. Now, I do know that's probably people that own them in their personal name, so to actually get to the real numbers of trusts and all this sort of stuff. But just by investing in property, you're ahead of the pack. Yeah. If that's what your game is, and then if you've sort of 3 or 4 properties, that is what most Australians should aspire to as property investors. Not 1,000. But so how many properties did you have when you work out that things weren't going right?
I think I was. It's actually an interesting story because I was first living in a principal place of residence, and I was paying off a mortgage, and
the Australian dream.
Yeah, and then I went to my wife and I said, "Let's blow this all up. Let's sell it and go put it all on red because YouTube looks good, And she was like, "Yeah, that sounds really good." So we actually were living this perfect dream house and beautiful house with a pool and the kids, and it all looked really good. And we decided, no, let's just go all in and sell it all and then reinvest in. It was very, very simplistic thinking. So we thought, okay, we've got a loan for this price. We can sell it for this price. We can break that up into 5 mortgages and 5 loans, 5 properties. Wow, what are we doing in one? We're silly. We should just sell this and go and buy 5 more. And so that's sort of what we did. And then and then we were like, wait a minute, we need a house to live in ourselves, and you can't just keep buying properties. That was like a myth. So it was kind of just figuring out and pedaling backwards and
Why did you what's the psychology behind wanting more? Why did you think that wasn't enough?
So I think I was in a similar, like a life position. There was a couple of things. So the first thing was I was sort of in my early 30s. I just crossed into my 30s, had kids, and I, like a lot of people probably, what I did, I ticked all the on reflection, I ticked all the boxes of life that society tells you to tick. But I did them way too quickly. I'm a bit of an overachiever. So I had house, mortgage, kids at 26. And then I'm just sitting there going, okay, this is pretty depressing.
Is this it, is it?
Yeah. And then a couple of years of probably way too much drinking and eating and just bored. And then I had a bit of a health scare, which turned out to be nothing. But that kind of shook me, and I was like, what am I doing? Why am I living this life? And I thought, this is not what I wanted. And I did all these things that everyone told me to do. I went and got married and engaged. And as soon as I got the girlfriend, everyone's like, when are you guys getting married? Okay, we'll get married. And when are you having kids? Okay, we'll have kids. And then you sort of look in the rearview mirror and go, wait a minute, what happened here? That was 10 years is gone, And so that was sort of a bit of a health scare and kind of backed me into a wall and said, you know what, no, I need to do something different. I want to do what I want to do. You know, I want to make life a bit more exciting and don't just want to live in my opinion, I guess, the boring Australian dream, you know. So it's I don't knock it, but it's not for me, you know. I want to be a bit more exciting, I guess. And I guess that sort of was the catalyst to making a change of wanting something different or wanting something more.
Yeah.
And property, I guess the thing is that property is like it is the great Australian dream. And so you hear about like the reason why I got into it was honestly, it's very simple and it sounds very silly, but I was thinking, you know, old people that are rich, they always say, oh, I bought this place in Sydney like 50 years ago. I bought that place and it's like worth this much. And I thought, I could be one of those guys. I'll just buy one of these places and I'll wait till I'm like 60 or 70 and then I'll be one of those guys. I just have to hold it for that long. And that was literally what I was thinking. And then I thought, let me buy properties. And that was it. Not much further thought to it.
Are you going to be that guy?
I hope so. So that's what I'm working towards.
So you checked in with Paul because you went down a pathway, you've liquidated the principal place of residence, you've turned it all into investment debt, you built a portfolio, but you worked out something wasn't right about the portfolio. It must have been, was it like a structural thing or was it something which
it was just
right?
not buying strategically, not following like Paul always says, the data, you know. It was just like, oh, this looks cool. Okay, that should be good. Like I was a bit lucky though, because I didn't go to the Darwin market. I went to the Brisbane market, and I bought apparently at the same time everyone else was buying in Brisbane, which was kind of in that 2015 time. And so it was just lucky that I bought in Brisbane.
But nothing would have happened for probably 3-4 years in Brizzy. Brizzy was slow until
2020, more or less.
That's right. Yeah. So that's what was happening was I, based on the, you know, like the YouTube bros or whatever you want to call it, which wasn't as much back then, but it was still a little bit. It was like, okay, buy this and then it'll just somehow magically any house will just magically go up in value. And then, you know, you'll just refinance it. And it's kind of like this secret thing that you can just get money out of nothing. And it just, like anything, you know, it just sounded way too good to be true. But as a younger guy, I guess it was, you know.
So you didn't go, it wasn't too bad though. What you created was a portfolio. It was probably costing a lot of dough to hold, was it?
That's right, yeah. And one of the things was like I bought a block of units, which I shouldn't have bought. And then that was costing me a lot to kind of just keep renovating, like maintenance and just little things of buying incorrectly. And even within that Brisbane market, which I've heard lots of people talk about and you guys talk about here, there's always markets within markets as well. You know, you can go and buy in Brisbane if you're buying next to a flood zone that's this and that, and no one's going to want to buy that property off you, you know, and it's not going to go up, and you have to buy the right places and the right, you know, so some of them were good, some of them were not. And just had to roll with the punches.
So you caught up with Paul then, and that was really about shuffling the decks to work out what you had, whether or not to keep it, and then how to reconfigure and recalibrate?
At the beginning, it was more to get a bit of probably like confidence from a professional and feedback. And then ideas of what I could be doing, what I should be doing, what I should focus on. And, these things with property, it's not an overnight thing. So it was like a few years before I could kind of, move the needle a bit. And then...
so you stuck for a bit?
Yeah. And then and that's how it is. But I have found in terms of stuck for a bit, I have found in general with the property game, it does go in like waves. So you like I haven't bought a property for the last 2 years, but then now suddenly there's like potentially like 3 going in the next 3 or 4 months, but it's just sort of that's how it's always been, But if for the last 2 years, you might have thought like I was in a slump or something, but you've just got to keep working on the game, I guess.
And it's okay to be sort of paused for a while because if you're buying correctly, then the market does the heavy lifting. So imagine you got a professional job, you make good, you don't tell me how much you earn, but you make good coin. Is it enough to drive a productive sort of portfolio expansion still?
Actually, so that's actually interesting. I don't earn a huge amount of money. I've got my own business, and I don't actually take a very large wage, and I spend a lot back into the business. I've sort of got this big philosophy about just keep reinvesting until it just blows up and gives you money. Hopefully it works. And so I would say my wage is probably on par with your average kind of corporate wage. It's not in the sort of 200 grand or anything like that. It's probably kind of mid 100s.
Okay.
And for someone of my age, it's probably pretty low. But I subsidize it with, I guess, some business income. But that's also one of the reasons why I got into this. One of the reasons that helped me, I guess, make the decision for the property thing. And I often tell people, especially my employees, to try and get into investing in property because it provides, I don't think it's good to be desperate for your wages. And you can then be a little bit more choosy and picky on what you want to do. Like, for example, with me, I don't have to take such a huge wage for my business because I've got a property portfolio that's giving me wealth and giving me satisfaction, but then also it allows me to keep reinvesting into my business. And my business is now, in its tiny little kind of game, it's the market leader by a mile, and we're continually investing on new things that are just putting us further and further ahead. So
the idea being that you'll be an acquisition target at some point. You'll be able to divest that out when it's time and ready to do it. But you're really leveraging this old adage of make your money in business and park it in property, right? So you've got a parallel business. You've got a cash flow business, and then you've got a.
That was something, I'll tell you. I was at this. You go to these weird, like not weird, like these business kind of seminars, the day seminars. There was a guy, I can't even remember when it was. I was in like my early 20s. I was at this business seminar. There was a guy that looked so flashy in a suit, and I was like, wow, this guy must be so rich. And he talked about getting a tailored suit, and I was like 22 or something. I was like, wow, a tailored suit and like $10,000 or something. And then he and I was just so enamored by this really flashy looking guy. And I don't even remember what his name was. But the thing that really stuck with me was what you just said. The very last sentence was, do the Australian dream, make money in business, park it in property. Thanks very much. Walked off. But that stuck with me. That one sentence, I was like, what did he just say? That sounded like gold. And I like that's kind of what it's been. Just keep parking it all into the investments and delay gratitude.
So sorry, Paul.
I was just going to say, you mentioned something there because obviously most people who are listening aren't necessarily business owners, but you mentioned, Ali, there is that what you talk to your staff about, and most of the people we work with are PAYG or salary earners. But one thing I learned before I started Pure Property, well and truly decades ago now, was if you treat your day job as your meal ticket to retirement, regardless whether it's a business or whether it's a PAYG, most people are PAYG, that is really the golden handcuffs, because that is the biggest mistake I see most people make, is think, I've got to climb this corporate ladder at all cost, and I get 2 leases on 2 very expensive cars. I get that dream house with the big mortgage, and I know that based on the numbers, I need to keep climbing this corporate ladder, and I need to work till I'm 65. I'm not suggesting that you don't do that, but I think the advice you're giving to your employees is treat your day job as the ability to enable you to do other things. And property is certainly one of those things, if done correctly, is that what you're building, and that's going to be far more meaningful from a financial standpoint than going from $150,000 to a $250,000 a year salary in 5 years' time. And I think the more people start to focus on that, don't worry necessarily purely on how much more you can earn in your job. Worry about how you can use what you've got available to exponentially increase your ability to make money outside of your day job. Because even if you double your salary, it's only a finite ability to make more money. Property does, with leverage, enable most people to go further and further than what they could ever do in their wildest dreams in a corporate career.
Well, it's about utility of money, and I think the key mindset for most people, if they're PAYG, is to actually understanding money is just a mechanism of utility for you. It's how you choose to spend it. If you put it into depreciating assets, okay, that's your prerogative, and you go on a holiday every year and do whatever you want to do with it. But park that dough. I was chatting with 2 people over the weekend, and I was sort of driving somewhere with them, and one of them probably earns pretty good money. They've been sort of multiple hundreds of thousands of dollars a year, I would imagine. And another person sort of like I call it a FIFO type worker, like a month on, month off type worker. And she said, I paid $60,000 in tax this year. And I went, well, what are you doing with all your money? She goes, I just keep it in the savings account. And the other one was like, oh yeah, you don't want to know how much I pay in tax. She has a principal place of residence, and that's it. And I said, guys, like, what are you doing? Do something. Don't do what you're doing right now. And I said, how dare you do this when you know? But seriously, they felt like I think you know who I'm probably talking about.
Yeah.
They felt like sort of scolded school children.
Yeah,
the next day they were sort of a bit sheepish, right?
Yeah.
You know, and I'm like, guys.
Sometimes, I mean, and you would have. I know you feel you wouldn't have wanted to have that conversation with them, and you wouldn't want to go into much detail. But sometimes people just need some sort of awakening, and you don't need to go and do something revelationary where it's completely different. But like, you need to do something here because this is not going to get you where you think you want to be, because you go in the opposite direction.
Oh, opposite direction, absolutely, completely. But so tell me about the portfolio today versus the portfolio as it was when you first met Paul. Is it grown, has expanded? Is it look differently?
Yeah. I think at that time it was 5 properties or 4 properties, and now it's like 14. Okay. So there's quite a lot more.
And sort of valuation from then to now, what do you reckon there's sort of clocking in at?
Yeah, I think at that time it was about like 2 to 3 million, and now it's like probably like above 9.
Okay.
So it's good. And it's in terms of the style, I think I was actually thinking about that on the weekend about what I'm thinking about for future properties. And I think your style of properties evolves based on, the beginning, maybe you don't have as much money, you've got to go something simpler. And then if you've got a little bit more established portfolio, you can make sort of bigger choices, better choices, be a bit more picky. Like, as I've said to Paul, because I've had some bad runs on units. Not that units are bad, I've just had some bad luck, 2 bad luck scenarios where I've just emotionally, I'm not going to deal with it anymore. I'm not prepared to, I am very much a protector of my mindset and stress. I want to kind of do things where I don't want to put myself under unnecessarily like stress and pressure. And so, so that's basically I don't want to go down that path. So but that was something I needed to have in my portfolio to basically start, because you can't start otherwise. I can't go and buy like an $800,000 home first up. You might need something smaller, but 300,000 to 400,000.
So in terms of the layers of decision making inside of making investment purchases, where does it being stress-free sit as a? Is it number 1? Is it number 2? Is it like I want capital growth and I don't want it to be too hard, or like where does it sit in your decision?
Well, I think that this could get into a whole different podcast around mindset and stress. So it's around. I've said something about this recently. Stacking people around me that I trust, that I can lean on to minimize that stress, because it's a very complex, there's so many different parts to property. There's finance, there's buying, there's selling, there's holding, there's all these different things, and you can't be an expert at all of it. You might understand one of it, but if I'm a maths guy, I might not understand the non-maths part of it, and so then the parts that you don't understand, generally stress comes from lack of understanding, from my experience. And so it's about having people that can bring that understanding for you, that you can lean on, or in the areas that you can't understand yourself. And for me, it's just at a point now, particularly with the property stuff, where literally Paul says, sign here, and I say, okay. It's very rarely a question, because we're at that level of trust and understanding.
And you're happy to pay for that?
Yeah. Oh, no question.
Yeah. So this inverse calculation of stress versus dollars, as in life can be a lot less stressful if you're happy to pay people to do the stressful bits for you.
The right people that you can get along with.
Yeah.
That's very important. I think there's a lot of personal side to it that many people don't give credit for. Like, I have to, whether or not I actually know who Paul is in reality, within my mind, I have to have a character of who Paul is, and I actually have to like the guy and want to support him, support his business, and basically, I think if that happens in my mind, I think, that guy's a good guy. I can work with him and support him, and he's looking after me, etc. And I make that story up, then it will minimize my stress. It's kind of like the narrative.
So you don't second guess his decisioning is the key thing, and this is about trust in a relationship. Right?
That's right. Yeah. And it's about maybe at the beginning I may have, but
so did you work him on that? Did you actually sort of test to see whether or not, how do you feel comfortable with trust? Like, what's your mechanism
for
for
me,
creating it?
it's around the conversations around, can I call this person and will they just answer my questions? I don't, here is the interesting thing. I've gone on a personal level. I used to actually think I was, for example, when I bought those properties, I thought I was better than Paul at buying properties. Yeah. I thought I was an expert at everything, like a lot of people do. And I guess I got humbled through life and through various personal development stuff. I started to learn that, no, you're not an expert at everything. And it's probably the successful people surround themselves with the experts around everything and move forward. But it's more personal. Like, can I just have a conversation with the guy and can I understand him? And then do I trust his expertise? Yeah. And then, but the things I would test on, it wouldn't be like, oh, what do you think about this property? Because I don't know about property. So what am I testing? It'll be more like, can I give him a call and will he call me back in the time that I expect it? Will he say the things to me that I want to say, that he want him to say to make me feel comfortable in this process moving forward? That to me is more important than what are the numbers on the house? Because if I pretend to know that, then I'm just pretending.
So it's sort of a mindset thing. Do you actively seek professional development in a proactive way? Because I've noticed, I've spoken to people for years and years, and there's people who are very conscious of it, and they deliberately try and manufacture personal development. And there's people who aren't, and they expect it to happen by osmosis.
Yeah. So I do a lot of personal development, but that was actually, and I think when I first met Paul, actually, I don't know if you recall, but I would have been double the size of what I was before. I don't know if you
definitely slimmed out.
Yeah. Yep. I was probably about 50, 60 kilos heavier than this.
That's because you bought too much property, mate.
Not enough money.
2-minute noodles. Yeah. But basically, I was not in a good mind space. And that's one of the, like I said, I was blowing up my life trying to find something new. And then I did, like what they say is when they say, like when the student is, I guess, ready, the teacher arrives. I just met a personal coach at an airport on a family trip. It was just random. I was at the Qantas Club, just started chatting to a guy, and then he was like, I'm a personal coach. And one thing led to another. He obviously could see that I needed something, and then I just did some personal development stuff. And I guess after I did that stuff, I started to realize the worth of it. So it's very interesting just from a financial thing, aside from the other benefits. I paid $5,000 for this personal development course, which I remember when I paid it, I went straight to my wife. Like I literally pressed send on the button, and then I went and go, I've just been fucking ripped off. I literally pressed send, and she's like,
was this with the bloke at the Qantas Club?
Yeah. And
do you reckon he collared you and said, I'm going to have a chat to that bloke? There's a perspective.
He's my mark.
He's my mark.
Maybe, yeah. Well, I think they do, yeah. And so literally I was just like, what a moron. Who the hell pays $5,000 for someone to just talk to them? Like this is so stupid. But then I thought, you know what? It's only 6 months, Ali, just do it. And, you'll go back to your normal life in 6 months. Give it a crack. You've done worse things. And I just started doing it. And then, everything just started changing. And that thing was $5,000. And I made like $50,000 in cash in that 6 month period. And I was like, okay, I'd 10x the investment on this. That was pretty good. And then, I guess I was sold on that kind of process of developing yourself and looking within and mindset and
I think that sort of, and it's not that it was a sliding doors moment necessarily, because it was a bit of a compounding effect of multiple conversations with multiple people, but changing your processes, changing your ways to how you want to get to where you want to get to.
Yeah.
But if I reflect on our working relationship, Ali, and how you built your portfolio, just purely looking at property, you are what I would deem to be probably the perfect property investment avatar, in the sense that you've made investing, you've tried it, and I don't necessarily think people need to go out and make tons of mistakes to then figure out the right way necessarily. But when you did start, you didn't start the day we had a conversation. You did what you needed to do. You got your ducks in a row, but eventually, once you realize, okay, here's the next step, that step started. But it's not just the trust between you and I. There's a whole team of other people who, we don't do your finance. We don't do your depreciation schedule. We don't do your tax. We don't do your law as part of the conveyance. But there are people along the way that we've connected with, and now you've got to the point that there's inherent trust on each of these people. And once you start to say, okay, that's an outsource. I know who they are. I can pick up the phone and I have the process now aligned. That's allowed you to go from that 2 to 3 million portfolio to this 9 million plus portfolio with a massive spread on your actual LVR, and also not exponentially increasing your stress or your time involved in that, because you've started to figure out, okay, this is the process I want. This is who I want in my team. And I need to just outsource and I'll get out of their way. Yeah. And I think the fact that you've been able to do that just has allowed you to do what most people probably, not most, but a lot of people can do, but they restrict themselves by not going through those motions.
Yeah, yeah. And to just build on that, like, if I was to do it again, because my daughter is turning 18 in 6 months, the first person she's going to be dealing with is Paul. So if I was to do it again, I wouldn't.
You got to force her into making it buy a property.
Yeah. I've already started speaking to her, and I've already helping her with the savings and all of that kind of stuff. And it's like, that's the first thing you're going to do, because I guess I wish someone forced me into it when I was 18 and 19 and 20, because I remember when I started meeting people from school that were like, when we went to the 10-year reunion, anyone who was forced by their parents, there was only a couple of them that was forced by their parents to buy property for some. There was one of the guys, he wasn't very bright, but he was going nowhere, and his parents said to him, look, you're okay to go nowhere, but you have to buy a house straight out of school. And then he was like, okay, whatever. I don't know what these guys are on about. Whatever, I'll buy it. And then, he was like a millionaire at 28. And he had like 3 houses, all around Sydney. And we were just like, who the hell is this guy? And he was not very bright at all, but he bought houses because his parents forced him into it. So again, I was like, well, I'll do that. So, yeah.
Makes sense.
Love it.
So what's the next then? So strategically, it sounds like you've got a pretty comfortable posture, so you got to get to the tactical elements. So you're buying now, are you?
Yeah. So I guess I think it's that next phase of the portfolio. I'm at a point where I could leave it if I wanted to, and it could kind of just pay itself off, and it's fairly comfortable.
Is it positively geared now?
Ish. Pretty positive. Okay. Some are, some aren't. So it kind of all evens out. But I guess the people that know me, that I just never stop. I'm always going a million miles a minute, and I won't stop till the day I die. I'm that kind of person. So I just want to see what I can do and see how much bigger I can make it.
So you're not chasing retirement, because if someone going, you're going to retire at 65 and stop doing anything.
No.
Just do whatever you like, to garden or whatever.
No, I learned. I'm very lucky. I have a good relationship with my parents, and I'm pretty similar to my dad, and it's really good that I watch them, I guess, mistakes in a way. So my dad retired, and then quickly went back to work because it was like pretty destructive very, very quickly. And I thought to myself, if I retire, I'll probably be like a heroin junkie or something within about a month and down the bottom of a ditch. I can't be left alone. I need to be working with people, for people. Yeah, I'm a worker. So
it's funny you say that. As you just asked that question. You've got a very similar mindset, and also your time frame is very similar. We've had another client of ours, William, on this podcast, sitting in this seat probably about a year ago now. And if anyone wants to go back about 12 episodes prior, you go and listen to it. Fisherman.
Yeah.
And he's in a very similar position to you financially. And also we met when he already had a small portfolio and sort of needed to rejig things. And he's at the point similar to where you are now, but his motivation is completely different.
Yeah.
And I think the point there is that your motivation doesn't need to be aligned to the next investor, to the next investor. Your motivation is your motivation. And where you want to get it to is absolutely your prerogative. But I think how you've got there is very similar to him, where he's like, okay, I outsource this. My intention is to go fishing. I actually got a random text message from William maybe a week and a half ago. He was down at Bermagui chasing the yellowfin tuna run, caught his dream 55 kilo yellowfin tuna, because that's what he stopped work. He doesn't need a lot of money.
It was on about a month ago.
There you go.
And Bermagui being, what's the closest place to the shelf? He loves it.
But this is it, right? But I mean, that's where he wants to get to, and he's got there over 10, 13 years. It wasn't getting there in 2 years. But again, his intention is his own intention, but he's kept making decisions and pushed himself to get there and surround himself with people that he know he can trust and outsource to.
Yeah. I actually I remember that episode actually well, and it's a good point because that's something that once you and especially after you do a podcast or something, every man and his dog comes to me all the time. Yeah. Especially people know that I've got property. Ali, where should I buy next? What should I do next?
So where are you buying next?
So what I tell people is,
I asked you.
So my answer to you is, the first part is there's 2,560 suburbs in Australia. So that means you have 2,560 different strategies and goals that I can align you to. So first you need to tell me where the hell are you going? Mm-hmm. What are you doing? Why do you want this? And then people go, just tell me where to buy. No, I can't do that because I don't know what you're trying to do. Right. So that's the perfect example of the thing is that he's figured out what he wants to do and that's what he wants to do. And then that's great. And that's like people ask me all the time. And that's the first thing I say to people is I can't help you unless you tell me what you want to do. Yeah. And I won't even refer people to Paul, if they can't tell me that. Because I'm like, look, I'm not going to refer you to him because he's going to ask you that. And he's going to go, what do you want to do? And if you go, I don't know, then he's going to be like, well, I can't really help you, can I?
The gatekeeper.
Yeah.
And I love it because, I mean, and it's not that you need to have a where do you want to get to sitting there in as you're shining light on a bench necessarily before you start. But you do need to also follow that up with a couple other questions. Do you know what you can do? What is your surplus cash position? How much debt can you hold? Have you checked your serviceability? Are you on page with your significant other? Do you have a spouse? And if so, are you guys collectively? Because I look at those things
I've got
so
to go
important.
Onto the pay scale if he wants me to follow up questions.
Yeah, exactly.
Like,
I'll give you a list. I'll give you a list, the checklist to ask.
Maybe.
But I love it because that's the mindset. And we've talked a lot about mindset in this podcast, and I think I wrote a lot about it in my 2 books, Philip. Mastering the property investment mindset. Yeah. And I know it just sounds arbitrary as far as get that investor mindset. And you don't need to have it before you start. But I think you've curated that over the journey, and that's made you so much better at what you're doing and why you're buying this next tranche of property, because you're like, okay, I know why I'm doing it, I know where I'm doing it, I know what it's going to necessarily be as far as what it's going to fit. And that mindset part is a key component to what a good quality property investor typically has as part of their bag of tricks.
Yeah.
Nice. Good. I enjoy the chat, Ali. It's you certainly know where you're going. I don't think you're going to stop. So make sure you keep in touch. And
yeah, well, I don't know.
If you need to
exactly
actually meet some good buyers agent, you come and talk to me.
Yeah. Well, that's actually another interesting point, which is a good plug for Paul, for me anyway, is I actually think if you start, I'm interested to hear your opinion on this, Paul. I think if you switch buyer's agents, it's can be extremely detrimental to you because I think because I've spoken to many and so on, but everyone's kind of got their own little spice. And if you switch, then it's like you're on a train line and all your properties are on that train line. Then you go onto another train line and it could be like completely different sort of tracks and might not work. And I think it could be potentially very dangerous.
I think it's a fair call that. Yeah, it's starting again, and if you're using a buyer's agent because you think tactically they can find you a property that's going to grow faster than the next guy, it's probably the wrong type of way to be assessing buyer's agents. And there's literally thousands of them out there, and they're all sort of singing from a very similar hymn sheet. So look, you may outgrow your buyer's agent at a point in time, like you may outgrow a accountant. But if you've been working with someone for 10 years and they're keeping current and consistent, I can't see any really good cause for changing.
The outgrowing is actually a very good point. That's something that I learned a little bit the hard way. You do need to drop the people that aren't performing as you grow. Like, for example, and I think a common one I would assume, because I fell into this trap, is an accountant. Like I dropped my accountant because he was like everyone's first accountant, my school friend that did accounting. And then the next one was a little bit better. But then as everything of mine grew in the business and everything, it was just like you could start to see cracks. And they're like, no, everything's fine. I'm like, I don't think so. Everything's taking so long and you're making so many mistakes, you know? And then I asked them, who is their like biggest client. And then I was like bigger than their biggest client, you know? And I'm like, oh, this is
that's
really
not
bad.
where I want to be. I don't want to be.
No, this is really bad. And then, so I changed them pretty quickly after that, you know? Yeah. So yeah, because I was like, you really don't know what you're doing with me. I don't, yeah.
Well, one of the areas where you do outgrow your buyer's agent, it might be a very good buyer's agent, but I hear it from a lot of people where they don't get the connection or the connectivity that they used to get if a buyer's agent grows. You know, that's probably a tough way for buyer's agents to scale, because they start down this pathway and you sort of working really tactically with their clients, but then they get to a point where you're speaking to completely someone else.
Yeah,
they don't love me anymore. So
again, I think for me personally, because I'm in business, I understand how that sort of stuff works, and I don't mind that. Again, if it was the original, like I will deal with, Paul's offsiders and colleagues and that's working with him. But
you don't need to be doing the admin with him, right? Someone else can be doing.
Yeah. But I know if I had a problem with any of them, I'd go straight back to him and say, hey, look, I'm having a problem with these guys. Can you help me out? So, like I said, it goes back to that original channel of relationship, knowing that I feel comfortable doing that, and so if he wants to send me to someone else, that's fine. I know he's sent them to me, and I trust him, and so that's fine.
That's cool. Nice one. All right. Well, thanks for coming in, Ali. Paul, thanks
Ali.
for bringing
thanks,
us
Phil.
in. That's cool. Anything else going on in your world? What's the latest? You got a new book offer?
No new book offers. No, maybe audio
book
book offer. We're going to have something for. We've got
Christmas stocking fillers.
Christmas. I can't fill stockings with audio books, unfortunately. Maybe gift cards, etc.
What about like a talking glossop doll,
like a bobblehead? Buy now.
One of those hula girls on your dashboard.
Yeah. For sale signs. Just bought. No, there's nothing of that nature coming out, mate. But there's some exciting stuff around podcast stuff, and we're already starting some pre-work around the Fast 50 for next year as well.
Crazy.
It's crazy to think about. We're in October talking about 2026 and 2027, but it never stops. It never stops. We've always got to look, and we've always got to make some critical calls as buyers agents and property investors. So that's what's happening on the horizon for us.
All right, but they can find you. We're at
purepropertyinvestment.com, or send us an email if you want to catch up. Have that initial conversation that Ali and I did a decade ago at inquiry@purepropertyinvestment.com, or they can even just go old school and give us a call at 1300 98 5428 and lock in a time to actually have that first conversation.
All right, there you go. Well, thanks everyone for tuning in. It's the Pure Property Podcast with Paul Glossop. We'll see you again next time. Until then, bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs, and should not be relied upon. Before making any investment, insurance, tax, property, or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.